Major funding for this program is made possible by grants from Bank of America and Perfect Building Maintenance, Greenberg TRAURIG, LLP, New York Community Bank, Kilroy Metal Products, New York Window Company, Capital One Bank. Additional funding for this program is made possible by grants from Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard ELLIS, Cushman & Wakefield, First American Title Insurance Company of New York, F.J. SCIAME, Friedman LLP, Gemini Real Estate Advisors, Hal Fettner Durst Fettner Residential, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Madison Realty Capital, Meridian Capital Group, M&T Bank, Massey Knackle Realty Services, MUSS Development, NEWMARK Knight Frank, Sterling & Sterling, Stonehenge Partners, the Moynihan Group, Urban American, W Financial Mortgage Fund.
Hello, my name is Michael Stoller. So where are we? You know, the apples are too far away from me, but where are we in the fall of 2009? The recession over, the world better, the office market better? I don't know. That's why I've assembled this distinguished group of individuals today to be here for the premiere of my ninth season, my 253rd show. My guests today include Mort Zuckerman, Chairman of Boston Properties, Joe Ficalora, Chairman of the Board, President and CEO of New York Community Bank, Steve Witkoff, Principal of the Witkoff Organization, and last but never least, Bruce Mosler, President and CEO of Cushman & Wakefield. I failed to say that Mort has some other businesses called U.S. News and World Report and the New York Daily News. Yeah. So Mort...
You assume they're businesses.
No, I didn't say they were businesses. You know, the question is, you know, we're not getting to the advertising businesses. So since you haven't been on the show, and since you control, you know, the chairman of the board of this large REIT, how do you look at the market today?
Well, we are in a group of selective markets, and by that I mean they're all supply-constrained markets. So that's one thing, and we're at the very upper end of those markets in terms of the properties we either own or build. And I would say this. We have seen, like everybody else, a decline in rents. The advantage I think that we have is that when rents at the kinds of buildings that we have decline, a lot of people want to go into those buildings. So we've had a couple of vacancies caused by bankruptcies, for example, Lehman Brothers being a classic example. But we're doing very well to fill up that space with other tenants at lower rents than we would like, but still the space is getting leased up.
Prior to the show, you know, we were talking about where the market is. Has it reached the bottom, you know, with regard to rents? We were discussing that. Steve was saying that. Or, you know, where do you see this? Have we reached the bottom on rents? You know, is the world going to get better? I mean, true, people want to go to Boston Properties, Class A buildings. You know, B buildings are in trouble. Lower Manhattan, you know my opinion of what's happening in Lower Manhattan, which we'll discuss later on. But where do you see rents today, Bruce?
I think you have to bifurcate the answer. I think that in terms of the economy, I'm not an economist, but I certainly do feel that we've reached the bottom. In terms of when this economy recovers, that's very much dependent, in my opinion, on jobs. You can't say you're in a recovery till you see the job loss currently taking place while it's declining. It hasn't stopped, and I don't think it'll abate till sometime mid-year next year. In terms of the real estate market, I think Mort is exactly right. There is a trade-up in class. For tenants that were in B buildings, they're certainly having a one-time opportunity to move into A buildings. And for the first time, I think since this time last year, sometime 60 days ago, the market turned, in my opinion, where tenants recognize that, first of all, there is stability in the financial marketplace, albeit no one knows exactly where it's going. But in terms of the 30 or 40% decline in rents, pick your building, less in Class A buildings, this is an opportune time for tenants to move, and they're moving. The investment sales market, I'll just touch on that. Michael, before you move on, I think it's a very different story. It's a tale of two cities. We haven't seen yet the reconciliation in values. We haven't seen debt become a part of the marketplace, and therefore I think that recovery is going to take into next year. It's really two different
but you bring up a couple of points which I'm going to be able to pick on certain matters. You bring up the investment sales situation. We realize that's down about 80%. And the price of a building is down. You know, the high building was $1,547 a square foot. You know, today buildings traded at $340 a foot, $380 a square foot, which I'm going to ask you a question, but I have to ask Joe a matter. Joe Ficalora owned the building on 35th Street and 6th Avenue. A company from Italy, very fortuitous for you,
Right.
bought your building, which is vacant now because they wanted it to be a vacant building, and they spent about $1,000 a foot.
1,050.
$1,050 for a B building? Nothing. I mean, you had bought Atlantic Bank in New York.
It was on the books of Atlantic for $15 million. We sold it for $105.
Pretty good return.
Yeah.
It helped the shareholders and the dividends.
Right.
But where do you, and this relates on two things. So here's a building.
They've defaulted, by the way.
Thank you. Now you gave them the exact answer. They defaulted.
Yeah.
So what's going to happen? You're a bank, and you have the situation. Now, you've done 85% of your loans have been multifamily. I mean, you're the king of multifamily, and I'm very proud to have you on the show because of that. But you've done some office buildings. You did the Brill building about a year and a half ago, where everybody said, I want tenants to be out of the building, the same way as the other building. What's going to happen today on these buildings? These are B buildings. These are not Class A Boston Properties buildings. Where do you see that?
Well, I think that what you're saying is true. You know, the rentals are adjusting rapidly, and they're adjusting down. B buildings will have more difficulty than A buildings. The New York market ultimately is a place where everybody that is doing well in the rest of the world ultimately wants to be in New York. So New York will do fine through the cycle. But I'm afraid we're in the beginning period of a long, difficult cycle, because every cycle reflects the cycle that precedes it. And the very robust cycle that ran from 92 through 2005, 6, 7, depending on where you were, was longer and more robust than any other cycle.
December 2007, you're on my show. I ask the question, are we in a recession? You say yes, no one says. Are we out of the recession?
I think that we are in the early stages of a very difficult cycle. We will go up and down during a period of years. We happen to be going up right now in many different ways, but I'm afraid that there are more reasons why we will trip and fall back and then go up again and fall back. There is not enough money in the system today to carry the refinancing of the existing properties that are in the New York market, in the London market, or in any other market. The issue is there is just not sufficient funding out there, because the source of funding during the robust times doesn't exist. And banks were only doing 40% or so of the lending.
Right.
So banks cannot make up the difference.
Bruce brings up the subject of unemployment. A couple of months ago, you wrote an article, an editorial in the New York Times, in the Wall Street Journal with regard to unemployment. Let's discuss it. Where, unemployment, the economy, and where this relates to the real estate world in general.
Well, ultimately, offices are intended to provide space for people who work. And when everybody is looking to pare costs, and they still are, and we have unemployment now continuing, in my judgment, still at a fairly severe pace, that's going to have a real effect ultimately on the occupiers of office space. So I think and I happen to be a little bit more pessimistic than most, that I still think that the unemployment numbers are still very unattractive. I think when you think about how long we've been in this level of unemployment, you've got a household unemployment rate, which means people who are working part-time who want to work full-time, and a full-time unemployment rate, which means people who are completely out of a job, of 16.8% of the workforce. Right. And that doesn't count 2.5 million people who have left the workforce, who don't count anymore. And frankly, it doesn't count about 1 million or so people who were working in residential construction, who were here illegally. They never showed up on the employment rolls. They don't show up on the unemployment rolls. You have the worst unemployment we've had since the Great Depression. Yeah. And that, it seems to me, is going to be the key. It's not the only key. I mean, the other thing is, our house price is going to continue to go down, and is credit going to begin to loosen up, or is it going to stay as constrictive as I believe it still is today? For these reasons, I share the view it may go up a little bit because of inventory replacement or the stimulus program to a small degree. But the fundamentals are not there to keep the economy going, and therefore I have the same view that you have.
Yep. Steve, what's your thoughts? You're very quiet today.
Well, no, I'm listening intently. I've listened to Mort before, and I think he says a lot of accurate things. I feel the same way. You know, the jury's out, Michael. But I know this, that when people do start to lend again, all these lenders are like lemmings. You know, they're all going to follow each other. That's what happened in the early 1990s. You couldn't get a loan, Joe. In '92, I can remember.
Yeah,
It just
we
didn't
actually were
exist.
lending more money in '92.
So,
But,
and I think
that was indicative of the absence of loans.
you know,
Contra
I think
recycling.
the lending market started, and I think there were a lot of smart people in the '90s who talked about why it started, CMBS and so forth. But at the end of the day, CMBS didn't really kick in until the late '90s and so forth. I think it started when all these banks were done doing workouts, and they woke up one day and they said, "Wow, we have no more workouts to do. Maybe we should lend." And that's what began to happen.
Okay,
And it'll happen
Okay,
again.
I have two buyers here, you and Mort. I mean, you build most of your buildings, but you would buy. There were a couple of opportunities this year. 1540 Broadway, the Worldwide Tower. Why didn't you buy it? Both of you. You have money. I mean, you have this REITs this year. Look at all the money they pissed away. Gave $15 billion to REITs. I mean, last year nobody loved REITs, and this year they love REITs. Why didn't Boston Properties buy any of these buildings in New York? Or why didn't Steve Whitcroft, who's been an active player, buy anything?
My recollection is we did some
did.
fair amount of purchasing last year.
No. I'm talking. I'm talking
I'm
this
just-
year. I'm
yeah,
not.
well-
I didn't say about GM building. I was talking
Right.
about this year.
Well, if a building of the quality of the GM building or Citigroup Center or 399 Park, just to mention three buildings that we bought, if
Or
a
you
building
changed
like-
it to 601 Lex. I just saw the new
yes,
sign.
if we saw another building like that coming on the market, we would look at it very seriously. But we have a particular kind of strategy and a profile of the assets we want to acquire, and we stay with that no matter what.
Steve Whitcroft. What about you on Worldwide?
And I have limited resources, and we saw,
I'll get the collection.
we've seen deeper, different opportunities out there.
So what are the opportunities?
We've been playing in Florida a little bit, where we see a lot of construction loans, and we've done some things there. We just bought a note, Michael, as you know, on an office condo at sub $300 a square foot. So we're active.
You know, Michael, I'll take a stab at sort of moving us in a bit of a new direction, but trying to stay consistent with where you're headed here. I think a lot of people are at this point in the marketplace unsure of where we're headed. If you're running a business, an operating business as a CEO, the only thing you can do that's prudent today, to Mort's point before about where and how long the unemployment is going to continue, the only prudent thing you can do is to continue to look at your cost side, and that essentially means jobs. I think that most people driving business, whether you're on the operating or the investment side, are still, the future's unclear. So the bets you have to make have to really pan out in the worst case scenario. So a lot of folks, I think, who have made the plays on the two assets you just talked about in New York had felt comfortable with the underwriting. Both happened to be seller financed, which was a huge component part of why they went. And both of those assets, I think, were just out of the mainstream a bit enough that the players who bought them looked at them as potentially worth the risk reward. End of the day, there are not a lot of trades, and the reasons are fairly, I think, profound. Number one, the banks have still yet to recognize some of the assets marked to market. We're not seeing deal flow on that side, and probably won't until more of that happens. And when we do see the deal flow, I think it will start not so quickly, Stephen. I think that it will begin fairly slowly and build with momentum as people have clarity in the market.
You know, relating to the banks, with the exception of certain banks, the banks are still not in the business. I mean, Citibank is
definitely
not
not.
lending. Bank of America is not lending. I mean, Capital One is lending to get a loan done. I mean, there is a loan getting transacted next month. It is and you're in it, I believe. It's a construction loan. There is a lot of equity in the deal. I mean, like 50% equity in the deal. It's a prime property. It's a $200 million loan. It is taking longer than ever, and it's a syndicate of 7 banks.
right.
Why isn't that? Why aren't people lending it? Are they all? Or are they waiting
sure
for?
of the
Are they
bottom.
upset with my Friday night article that every week there's another failure? I mean, and then they go back and then they said, "I
It's
can't."
your
lend."
article. You're driving the banks out. I mean,
Okay,
that's-
I know. Please, that happened 2 weeks ago. I walked into a guy. He says to me, "They won't lend to hotels because you said that." I said, "What do you mean?"
But you know, interestingly enough, failing banks actually represent an opportunity. So, for example, if we were to buy a $10 billion bank, even in another market, we'd have $10 billion that we'd want to lend in this market.
Right.
So the failure of banks isn't detrimental to the viability of the New York market. New York is not likely to see many local banks fail, even though there'll be huge losses in real estate in New York. Those losses are dispersed because the loans were not made by the local banks.
That's right.
The biggest loans were made by non-banks. And those funds, in fact, will result in losses in hospitals and colleges and
Right.
all kinds of holders of structured debt that didn't realize what they had, but certainly holders of structured debt. And that's dispersed all over the world.
I will say this too about the New York market. In the medium or longer term, when the world of global finance revives itself, it's going to enormously benefit New York,
Yes.
even disproportionately,
And it will.
say, to London. You know, the New York financial institutions had an average ratio of debt to equity of 31 to 1. But the British financial institutions, it was 61 to 1.
Yeah.
So whatever the problems the banks in New York had, it's nothing compared to what's happening to the London banks. And that was our major competitive source of global finance. And certainly, if you're looking at places like the Middle East, I think those markets are just gone. I think, therefore, there will be a revival of global finance, and it will help very much here in
You
New
know,
York.
you bring up the Middle East, and I mean, it's public knowledge that the people who bought the buildings with you, your joint venture partners, were sovereign wealth funds or companies from the Middle East. And I know you've dealt with certain of the people in the Middle East, and your companies have done this. Do you see the people from the Middle East coming back or becoming aggressive to come into the New York market again?
Yes, I do. I think there are a lot of investors from other countries who see what we see in New York in the longer term and think this is a buying opportunity. And by the way, it is.
To Mort's point, and now I don't want the optimistic side of me to get carried away, but I think if you look at the dollar against the euro, the pound,
Right.
this is going to be one of the, if not the most invested in marketplace in the world, because, Michael, not only is it the dollar that's cheap, it's the fact that at the end of the day, when you look at the risk reward in terms of where people went yield chasing in the last several years to foreign countries, they are going to be able to look at the same returns here in a safe haven in the world's financial center. I think we will find ourselves, as Stephen said before, pleasantly surprised when people actually get more clarity on the bottom. Right there is just enough haze that people aren't moving aggressively. The banks haven't moved aggressively to market, but when all these things start to come together, the confluence of those events are going to make this city particularly, I think, successful. And there are other major CBDs around the world. I wouldn't in any way, shape, or form not think that London and Tokyo and Paris, Tokyo as well, will also be beneficiaries. But I don't think anything like the New York market. Perhaps
New York's going to
a
outcompete
bit
London,
aggressive.
no doubt.
I think
I
so.
own 2 buildings in London. One
Yes,
of
you
them
do.
is one of the most important buildings in London. But I will tell you that London competed favorably against New York, and Mayor Bloomberg talked about it. And not anymore.
No question.
They're changing their tax posture over there.
No question.
In a huge way. Hedge funds are moving out left and right. So I agree with Mort. And
But
by the way,
but you bring up something very interesting.
the politics.
No,
I agree with you. Well,
Taxes,
you know what?
taxes.
We weren't going
look,
there.
I'm going there. I'm sorry. I'm
I
talking
would-
about the
I would
taxes in
imagine
New
that
York.
if you asked anyone in this room, they would tell you they invest behind proactive government. I mean, when Giuliani promulgated the downtown revitalization plan, people said, wow, you know, that's proactive government. I want to get behind that. I listened to the mayor on CNBC maybe 3 weeks ago, where he talked about this very point that Mort was making. You might have been on the show that day, I can't remember, but Bloomberg was on, and he was talking about London versus New York and the need to be a little bit flexible about what kind of handcuffs we're going to put on the financial industry. As the financial industry goes, so goes New York, at least for the time being. And it was very,
true.
very compelling talk, by
of
the
the
way. And he said, I said to myself, wow, that's good, solid stuff, assuming he's the mayor. And that's not to say, you know, I'm not a big, you know, supporter of anybody. It just sounds like cogent, compelling talk from the leader of this city. So I think New York's going to do great compared to London.
You know, I happen to be with Dan Doctorow, who's the head of Bloomberg.
Yes.
And he was talking about the number of new financial firms that have started, a lot of them spinning off from the travails of a lot of the older and larger financial firms. And they measure that by how many of these Bloomberg machines they sell. And he says, we've sold 3,600 Bloomberg machines to new financial institutions that have spun out of the old financial
Funny you
institutions.
say that, Mort. I actually saw Dan also, interestingly enough. Not that kind of conversation, but he sort of sounded a little bit optimistic when I talked to him, and he's a pretty bright guy. But I agree with you. I have so many friends who are at these larger firms, and they're all thinking about what entrepreneurially they can do.
Right.
And I think before they may have felt, you know, they had the golden handcuffs on, big bonuses coming. Now they're almost unfettered, right? There is no job. Let me go do what I always wanted to do, start my own business.
You know, I'd like
And that
to,
has a real
I'd
percolating
like to
effect,
digress
Michael.
a little bit. You know, we're talking about New York. We're talking about the economy. We're talking about, you know, you own the Woolworth building. We haven't spoken about Lower Manhattan. And I think there are problems, and from what I read, you don't own anything in Lower Manhattan. And you've never owned anything in Lower Manhattan. What do you see happening? You have Goldman Sachs going to be moving out of their space. They're going to be moving into their tower. You have Merrill Lynch moving out of their space. You have a lot of consolidation. You can have 8 million square feet vacant in Lower Manhattan. What's going to happen with Lower Manhattan? Plus, we're building the new towers and building other property down there.
I'll tell you this, I'm partners in the Woolworth building with 5 other people from, you know, varied and disparate backgrounds. And right,
That's
Bruce,
a nice
I mean, you
way
know,
to say that.
No, but I just want to make a statement to you because this is interesting. And we have a $250 million mortgage on the property that we think is a conservative mortgage. And yeah, we have leases coming up for renewal and so forth. But when the $50 million last piece in that mortgage, what you would refer to as the B piece, but it's part of the $250 million mortgage, when it came up to be bought, and we had an opportunity to buy it for $22 million, no one said, gee, let's go call a private equity fund and see if they'll fund us. 5 guys wrote checks, and we all paid $22 million and like bellied up to the bar and bought
Got a
that
good
mortgage
buy.
3
I mean, you
months
got
ago.
a big discount.
No,
on
but my
that.
point is that that's a bellwether. You know,
course it is.
Mort buying the
Of course it
GM
is.
building is a bellwether, and these are good. These are good things. These are good.
I think, Michael, when you look at downtown, well, first of all, we forget it's the 4th largest city in the world when in the United States when we put it together on its own. At the end of the day, I think infrastructure is still a very critical component part.
Do we look at what the
of
AIG building
downtown.
sold for?
We
they sold for $100 a square foot?
No, listen, I think you can look at it at $100 a foot. And
I don't think it was even worth $100 a foot as an
I don't
office
think
building.
you can look at that as a normalized value proposition for a quality asset downtown. Downtown is going through, at the moment, a transitionary period. And I think that there's no question that we have to be careful how much we build on spec. There's vacancy that has to be filled. Downtown has always relied on the as goes Midtown, so goes downtown to some extent because it has been an economic alternative for users. It's gone beyond that now, I think, to a point where downtown stands on its own merits, but it's still viewed as
Still a
it has
low-cost
to be,
alternative,
it has
correct?
to be an economic. I'm not going to say low cost.
Our rents in the Woolworth
Oh,
building.
come on here.
Let me just talk about what I think is the main infrastructure of New York City. It is that we have in this city the highest degree in both relative and absolute amounts of intellectual capital. You have a city that welcomes talent, nourishes talent, celebrates talent, rewards talent, and therefore attracts talent. And it's very interesting that the talent that is particularly attracted to the city are the younger folks who want to come in and like the quality of life here. This is the most critical element of this city, and if we can keep generally the quality of life in New York, this city is going to do very well over any period of time. And compared to any other major city, it is the city which has the most talent. And by the way, it's so interesting when you think about it. You know, Goldman Sachs has a building on the other side of the Hudson River. None of their talented young people want to work there. They want to stay in Manhattan.
That's what forced them into the move.
Right. Yes, it's exactly what's going on.
Yeah.
And that's the best thing about New York.
Right. And now housing prices are down.
Right.
And probably rental buildings one day will be built because housing prices are down, which is going to address some of the housing issues.
We have enough rental buildings being built right now. You go to the west side.
Not really. I'll tell you this, though. I bet you
Not
if you
affordable
I bet you if you ask Bruce to come back and ask, you know, some of his analysts at Cushman and Wakefield to do a white paper on what happens if there's no new office building construction in this city for the next 6 or 7
new
years.
office buildings?
Which, by the way, is probably going to happen. Right? I mean, you tell me, show me a bank that's going to lend on spec. They may lend to Boston Properties if they're putting up 40 or 50% equity with a big solid anchor tenant in
Let's
there.
look at it this way. Mort had a little opportunity on 55th Street. He had an opportunity on 46th Street. He put them on hold right now. You know, so many people, Vornado put on hold on 42nd Street. Now is not the right time to build. Well, in addition, Joe, if I'm talking about this construction loan, which is taking 7 banks to pray for 3.5 years
With a 50% guarantee.
with a 50% guarantee.
But my question, Michael, is what happens? That's really what happened in the 90s. Housing prices lifted because there was no new
we're going to have
product
to
for
wait
10
till
years.
next week to talk about that because we've completed 30 minutes. I'd like to thank everyone for the first show of the new season of the Stoller Report. I'd like to thank Mort Zuckerman, Joe Ficalora, Steve Witkoff, and Bruce Mosler. See you next week.
Major funding for this program is made possible by grants from Bank of America and Perfect Building Maintenance, GREENBERG TRAURIG, LLP, New York Community Bank, Kilroy Metal Products, New York Window Company, Capital One Bank. Additional funding for this program is made possible by grants from Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard ELLIS, Cushman and Wakefield, First American Title Insurance Company of New York, F.J. SCIAME, Friedman LLP, Gemini Real Estate Advisors, Hal Fettner Durst Fettner Residential, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Madison Realty Capital, Meridian Capital Group, M&T Bank, Massey Knackle Realty Services, MUSS Development, NEWMARK Knight Frank, Sterling and Sterling, Stonehenge Partners, the Moynihan Group, Urban American, W Financial Mortgage Fund.